In today's video, we're talking about the differences between unearned revenue and unbilled revenue, which are two different accounts on the balance sheet. One is a liability and the other is an asset. So we'll talk about some real life examples that show these two accounts, how they occur and how they are recorded. And then we'll talk about the revenue recognition standards under ASC 606 to illustrate how it drives these two accounts. So let's dive right in. We're talking about unearned revenue versus unbilled revenue. It's important to note that these two accounts occur because we are following accrual accounting, right? And under accrual accounting, which is recognized under US GAAP, accrual accounting says we record revenue when it's earned, regardless of when the cash is received and regardless of when the invoice is issued, right? We're not really concerned with when the cash is received or when the invoice is issued. We are concerned with the performance obligation that we have to our clients. When that is performed, then we earn the revenue, as we will discuss in a couple of minutes when we go over ASC 606 and the 5 steps to revenue recognition. Okay, so because we are following accrual accounting, we will inevitably go into unearned revenue and unbilled revenue, as we'll show here with a couple of examples. So in the case of unearned revenue, what we have is a cash that's been received or an invoice that's been issued. However, we haven't yet delivered the good or services, right? This is unearned revenue, which is a liability. Why is it a liability? It's because we received cash, so somebody gave us cash, but yet we have not yet delivered any goods or services, so we are liable to deliver the service or the goods at a future date. That's why unearned revenue is a liability. However, with unbilled revenue, which is an asset, what we have here is that we delivered the goods or services, so we've performed what we have to do to the client. However, we haven't yet either invoiced them or received the cash for this transaction, right? And that's why it's considered an unbilled revenue. Now, let's look at an example of unearned revenue so that we can understand it a little bit better. Marco Polo Incorporated sells advanced sound systems. On December 20th, 2023, they signed an agreement with a new client who will buy a theater sound system for $50,000. Marco Polo will deliver and install the system at a future date in January 2024. But the client paid the $50,000 to secure the budget internally. How should Marco Polo record this transaction? Okay, so in this case here, the cash has been received on December 20th, 2023. However, the goods or services will be delivered at a future date in the next year in January 2024. Okay, so let's go through the recording of this transaction. In this case, we said the cash is received, but the service or the good will be delivered at a future date. So under cash accounting, which is used by smaller companies and companies that follow cash accounting for tax purposes, which aren't many, the journal entry will be easy because we're following the cash. The cash is received December 20th, 2023. The recording is going to be a debit to cash in December and a credit to revenue in December. Next, we'll go into accrual accounting. But before we do that, if you're receiving value out of this video, I would ask that you would click the like button so that YouTube can distribute this video to more viewers. And if you haven't already, hit the subscribe button and notification bell so that you can get a notification for future videos that I make on accounting. Okay, so with accrual accounting, we will have 2 journal entries in this case, not 1, right? The first one is going to be in December, which when we receive the cash is going to be a debit to cash for $50,000, increasing the cash balance, and a credit to unearned revenue for $50,000, creating a liability, right? We are liable now to deliver this in the future. And the second journal entry is going to be in January of 2024 when we deliver the actual good or services, when we install the sound system in this case, a debit to unearned revenue, releasing that accrual, right? So remember, we credited unearned revenue, creating a liability. Now in January, we're going to debit it so that we can eliminate it. It's gone, right? And we have a credit to revenue, establishing or recognizing revenue in January, which is when we earned that revenue, regardless of when the cash is received, we earn it in January, not in December. Okay, so this is an example of unearned revenue. Let's jump into an example for unbilled revenue. And before doing that, I just wanted to mention that all of these concepts that we discuss in the channel are covered in the Controller Academy, which is the program that I created for which I received an average star reviews of 4.9 out of 5. So I'll leave a link to that down below if you're interested. Okay, so with unbilled revenue, we have an example. Catch Me If You Can LLP is a law firm. They charge $1,000 for each hour of service they provide. In the last week of December 2023, they provided a client with 40 hours of services for which they sent an invoice in January of 2024. So they waited until the new year to send the invoice. How should Catch Me If You Can record the transaction? So what we're looking at here is that the actual work was performed in December of 2023. However, the invoice was sent in January of 2024, right? So in the subsequent year. All right, let's go through the recording of this transaction. So services performed in December, invoice issued in January 2024. Under cash accounting, which is used by smaller companies, the journal entry is easy. You wait until the invoice is issued in January of 2024, and you issue an invoice debiting accounts receivable and crediting revenue for $40,000. That's pretty simple, right? But we want to follow accrual accounting, which is correct under US GAAP and IFRS. Two journal entries. The first one at the end of December of 2023, we're going to record an adjusting entry to say, wait a minute, we delivered some services here that we haven't yet invoiced. So we're going to be debiting unbilled revenue, which is an asset, which is similar to accounts receivable, and it sits as a current asset on the balance sheet for $40,000, and credit to revenue to recognize revenue in this case because we did earn that revenue. Journal entry number 2 is going to be in the subsequent year, right? Now that we're going to issue the invoice itself, we're going to be debiting accounts receivable as we are issuing an invoice now to the client. But the credit is not going to be revenue because we already recognized revenue in 2023. Now we are just going to release the unbilled revenue asset, right? We're going to say, let's remove that asset from our balance sheet because now we have a receivable, right? But the revenues already have been recognized in the prior year. Okay, so we went through a couple of examples for these two accounts. Let's take a look at where they show up in the balance sheet. So we have a balance sheet example here. Unbilled revenue, like we said, is an asset and typically would show up right after accounts receivable or around it on the balance sheet because it is a similar account in nature to accounts receivable as you are owed that recognition of that receivable at some point, right? For deferred revenue or unearned revenue, that sits as a liability, typically under current liabilities on the balance sheet, to illustrate that you're liable to a client to deliver a good or service in the future. Okay, so this is where it sits on the balance sheet. We also said that we want to talk about ASC 606 because these are the steps that are going to derive when you recognize the revenue, and therefore these are the concepts that create unearned revenue and unbilled revenue. Okay, so the 5 steps to revenue recognition. First one is identify a contract with the customer. So the contract could be either an agreement, a standard agreement on your website. The customer will click agree when they are buying or subscribing to your service. Or it could be an actual contract that you have to sign with each client individually. Step number 2, identify the performance obligation in the contract. So in the first example that we looked at, the obligation was to install and deliver a sound or a theater sound system to the client. In the second example, the performance obligation is to perform legal services. Step number 3, determine the transaction price. So in the agreement, you would say each hour of service, for example, in the law firm, each hour of service is $1,000. So this is the transaction price. Step number 4, allocate the transaction price to the performance obligation. So if your performance obligation is to deliver 1 hour of legal services, you allocate the price of $1,000 to each of these hours of legal services. Step number 5 is to recognize revenue when the entity satisfies a performance obligation. So as we've seen with the legal firm, we've recognized revenue in December because we fulfilled the performance obligation of delivering the legal services to the client. So these are the concepts that derives revenue recognition and the accrual of revenue. And therefore, when we accrue revenue, these two accounts arise: unearned revenue, which is a liability, and unbilled revenue, which is an asset. I hope that you enjoyed this video. If you did, go ahead and share it with someone else who might be interested in learning about this. And also, if you have a topic in accounting that you want me to cover in a future video, go ahead and mention it in the comment down below. And I'll see you in the next one.